Hey, what's up guys, it's Daniel here. Welcome back to the channel. In this video, I'm going to talk about an incentive created by the IRS called the Savers Credit, which was initially called the Retirement Savings Contribution Credit. This is a credit that is specifically designed to help people actually start saving for retirement and is definitely worth taking advantage of if you have the means to do so. And just a side note, this is not financial advice. If you are considering contributing to a retirement account so you can receive a Savers Credit, I suggest talking to a certified public accountant. So if you find this video helpful, I'd really appreciate it if you hit the like button. Okay, so let's get started. So what exactly is the Savers Credit? The Savers Credit basically gives low to moderate income taxpayers a chance to earn up to $1,000 as an individual and up to $2,000 as a married couple just for contributing to a qualified retirement plan. And this credit can actually reduce or sometimes even eliminate your tax bill. So who is eligible? To make a claim for the Savers Credit, you must meet the following requirements. You must be 18 or older, not be a full-time student, have made a contribution to a retirement account during the tax year that you were filing a return, meet the income requirements, not be claimed as a dependent on another person's tax return. And for 2021, your adjusted gross income must not exceed the following levels. $66,000 if you are a married couple that is filing jointly, $49,500 as the head of a household, and $33,000 for all other taxpayers. So now let's take a look at the Savers Credit rates and adjusted gross income for 2021. So if you're filing as a married couple, the following will apply. You can get a credit of 50% if your combined adjusted gross income is $39,500 or less. You will get a credit of 20% if your combined adjusted gross income is between $39,501 and $43,000. And finally, you can get a 10% credit if your combined adjusted gross income is between $43,001 and $66,000. Next up, as the head of a household, the following will apply. You can get a credit of 50% if your adjusted gross income is $29,625 or less. You can get a credit of 20% if your adjusted gross income is between $29,626 and $32,250. And finally, you can get a credit of 10% if your adjusted gross income is between $32,251 and $49,500. And finally, as a single filer, the following will apply. You can get a credit of 50% if your adjusted gross income is $19,750 or less. You can get a credit of 20% if your adjusted gross income is between $19,751 and $21,500. And finally, you can get a credit of 10% if your adjusted gross income is between $21,501 and $33,000. So as you can see, as your income increases, the amount of credit you can claim actually decreases. So how does the Savers Credit reduce your tax bill? First of all, it's important to know what the maximum amount you can contribute is. For the head of a household or single filer, the maximum contribution is $2,000. And if you're filing jointly as a married couple, the maximum contribution is $4,000. And how this works is quite straightforward. If, for example, you were filing jointly as a married couple and your combined adjusted gross income is, say, $40,000, you will fall into the category that will allow you a 20% credit. So if you were to put in $2,000 each for a total of $4,000, you would receive a credit of $800. Now, seeing that the Savers Credit is a non-refundable tax credit, it can actually reduce the amount of tax you might owe. So in the example above, there was an $800 tax credit received. This would actually come off your tax bill. So next up, let's take a look at what retirement accounts qualify. To be eligible to receive the Savers Credit, you can make contributions to the following retirement accounts: a 401k, either a 403b or 457b plan, a traditional or Roth IRA, a SEP IRA or simple IRA, and finally an ABLE account. And to make sure you do qualify for the Savers Credit, any contributions you make must be new money. Basically, you can't just roll over money from an existing account. Also, you can't claim any contributions that were made to these accounts from your employer. Anyway, that's all I have for now. I hope you found this video helpful, and if you have any questions at all, please leave a comment down below and I will get back to you as soon as possible. And as always, please like, share, and subscribe.